Okay, well, Jacques, thank you very much for joining us. Good to have you here in London with us this week. Obviously, coming off the back of tailwind late last year, early this year, you formed Samos Energy, a newly formed upstream energy investment platform. I wondered if you might be able to just kick things off by giving us a bit of an introduction to the firm, what your motivations were behind launching the firm, and what opportunities you're seeing in the market that sort of gave you those motivations to come and go out and launch.
Sure, yeah. Well, before the windfall taxes, otherwise known as EPL 1 and 2 in the UK, Energy Profits Levy, we at Tailwind debated going abroad and actually diversifying out of the UK when we kept losing quite a lot of bids as the UK got a bit hot for a while. A lot of hot money entered, chasing what were the good returns. And then we decided not to at Tailwind. We just thought to be a North Sea focused company. And that was a combination of Mercuria and the founders debating going abroad, maybe to emerging markets. I then thought to create a vehicle that could capture some of that. We had a feeling that there was some geopolitical risk, ironically, in Europe, given where the dialogue was going. We didn't quite expect such a random and unexpected, essentially doubling of tax and destabilization of confidence and investment, but it was roughly where the direction was going, and it did happen. And then sort of Samos became sort of a full-time vehicle after we sold to Serica, which was a great combination of two, like-minded companies and assets. So Samos really was about getting out of the OECD into countries that had a longer mental time frame for oil and gas and were willing to support the sector due to employment, GDP, and weren't ready to start just, winding down the sector as we see in parts of the OECD.
Okay, fantastic. Yeah. Well, I mean, this probably leads on to one of the questions I was looking to ask later on, but since we're on the topic, I mean, we've heard a lot over the past couple of days. We sort of heard from Gilad at Ithaca this morning. Obviously, the minister came in this morning around sort of how the UK government is increasing support for the sector, issuing new licenses to help slow the decline of production in the UK. Obviously, how the new petroleum bill will make the UK more energy independent. I think maybe removing the Samos out, does that give you confidence that things are moving forward? Does that, do you think, provide more stability for investors looking to come into the region? Do you think it will attract more investors? Or again, is it still fairly up in the air and let's wait to see how things play out?
Yeah, I mean, so full disclosure, I'm still a shareholder of Serica and still advising the company on quite a lot in terms of financing and strategy. So care about the North Sea, follow it as closely as I did at Tailwind. And look, the new moves are welcoming. It'll probably spur a little bit in the new licenses until the next election, at least. But I do think if you looked at when the North Sea stopped decline and actually had a little bit of production growth, it was not due to new licenses and exploration. It was due to actually people harvesting and optimizing existing assets. And I think that's where you've seen the biggest pullback, whether it's capital flight or paying down debt. So new licenses are welcome, but I do think there's a bit of a false debate on UK television and news about licenses. I think this is like less than 10% of the production decline solution. I think confidence and long-term stability and investing in our existing fields, that's where the UK's decline has always been stemmed. And that's not happening now. So that's why you see faster than, as the conference said today, faster than global average declines. So if after the next election, there can be sort of a 5-10 year plan, and then you might see the UK offset the decline.
Okay.
But otherwise, yeah, new licenses, incentives in decarb are welcome, and I'm sure they'll work out something on that.
Yeah, no, absolutely. Yeah. And I know when we've spoken in the past, you've sort of described how, in your opinion, the sector's mispriced. Maybe you're able to just elaborate on that a little bit. What's caused that? What do the markets need to see for energy stocks to start reflecting a fair value again?
Yeah, I mean, effective death of the IPO market. I mean, you've seen Ithaca, Vor, and these kind of names, but these are really, essentially selling off a small minority for controlling shareholders and ENI and Delic. So you've essentially death of the IPO market. Private equity more or less pulling out. There's a few exceptions in the likes of Quantum and EIG, and we hope Samos, but fundamentally, so I think equity has dried up, and it's now become almost by exception to find sources of equity, independent companies, maybe selling, reinvesting, et cetera. So that actually weighs on prices just by default. And then obviously debt has dried up. Now debt, I think the outlook is what we talk about more than the reality. I think there's still enough debt in the system, and we intend to use a lot of it, but I think the outlook is very bad for debt. And that also weighs on prices mentally. So even if today you can buy an asset, let's say in Gabon, as a solid did with a healthy RBL, it still might weigh on your price because in the future refinancings are harder, and long-term ability to financially engineer your assets, you'll take a bit off on that.
Okay.
So the mentality and the availability of equity today are weighing down on prices, and that we're seeing that actually beyond E&P.
Okay.
Yeah.
No, it's interesting. And I think obviously now focusing in a bit more closely on Samos, you recently bought an FPSO out in Southeast Asia. You're able to just share a few more details around that and sort of why that was attractive?
Yeah, so it was actually BlackRock and Petrofac's floating business. So 2 FPSOs, one Mopu in Malaysia, Thailand, Vietnam. Insourced the team from Petrofac in a few of those countries in Singapore. We weren't looking for it, but it had a lot of the features of an E&P asset. A seller who needed to get out. In this case, it was a fund cleanup. And you had essentially E&P-like exposure on aging assets that, had some upside in their extension. Now, we're not operating these assets. You have Harbor and Petrofac operating them in Valeura, but we essentially have a nice view on these late life assets and a good risk-adjusted return on their life. So as long as those fields stay producing and economic, we do get our day rate and tariff, and that's kind of a different way of looking at E&P through infrastructure. And again, sort of a one-off deal, but now we have developed a sort of a global benchmark of where that business stands in the FPSO market. There's about 7 or 8 main players, and we see ourselves looking around floating infrastructure more, turning that into a possible platform.
Okay.
And the same mispricing dynamics as E&P are there. Real lack of equity. Unlike majors, the difference is you have essentially a bunch of service and infrastructure companies that are over levered due to delays in delivery and CapEx overruns. But I'd say similar dynamic. The reason why they had problems is they had cheap debt for a while. Now they can't access debt, so they can't deliver those expensive FPSOs as easily as they could have in Africa and Latin America, where a lot of the new FPSOs are going. So the lack of capital kind of flows through the system, whether it's service providers, shipyards in Korea, late life assets. It weighs on prices, and that's a systemic issue. Oil and gas people don't want to touch it in whatever form. E&P being the most obvious, but now you see it elsewhere.
Yeah, and I think that brings us on to sort of the next point, which is around geographical focus. I think you've alluded to the fact you're sort of non-OECD focus. I mean, what is the focus area for you? Where do you see attractive opportunities? There's a lot of perceived geopolitical and country risk at the moment. So how do you determine sort of what underpins a good environment and essentially sort of lays the foundations for a good deal for you?
Yeah, so the non-OECD started with, let's say, the energy transition dialogue of the last few years, although it was different today and the last 2 days at WECA, but you could see your panelists talking about the imbalance of the European transition dialogue versus the African and Asian one. And we sort of transposed that into an acquisition strategy of, well, again, where is there going to be a mental longevity from governments and voters and citizens across the world? And we felt that Asia and Africa had that. And then we had to eliminate non-OECD countries where there was just no access. So we're not going to be going into UAE. We're not going to be going into Kazakhstan and Azerbaijan, where you essentially have some combination of NOCs and long life assets that require a lot of equity and long-term political stability. I mean, one way we manage geopolitical risk is looking for late life, shorter term assets with local partners, with a combination of insurance and hedging. We'd rather play that geopolitical risk to some extent than parts of Europe where, anything can happen after an election or after an inflation cycle. Yeah.
Okay. I guess finally, what's next? Obviously, you got the first deal out of the way in Southeast Asia. So what's on the horizon, if that's something you're able to elaborate on?
Yeah. So, I mean, our stated regions are Southeast Asia, most of Africa, probably not North Africa, and parts of Latin America, but we're definitely going to be biased towards Asia. We're now present in 4 countries with teams, with engineers. We have infrastructure, there's some synergies to building around that. We're shifting some team there. So we actually have the majority of Samos is now actually in Southeast Asia, with the rest more deal people in London. But that said, I mean, we're in plenty of data rooms in Africa as well. And the one hedge on Africa is there's a lot of good companies that were here today and looking around Africa, building businesses. So we might look to partner with them maybe rather than compete, because you have a lot of competition in Africa. So maybe take a tactical approach to each region. Asia, there's funnily enough less capital than Africa. That was probably one thing we learned this year that we didn't quite appreciate. We thought, but I think China is a big part of that actually. So you see a lot of Chinese money is now out of OMPs, not something we ever talk about, but actually when you go to Indonesia, that is a factor. So, there's local factors, and I think Africa, you're going to see quite a lot on the market, quite a lot of bidders, but we'll keep browsing there. And then Latin America is really on a case-by-case basis.
Sure.
You can see Argentina, Colombia. You got to pick your time and do it with the right partners. Yeah.
No, absolutely. Well, look, it's an exciting time to be in the industry. Obviously, look forward to keeping an eye on your progress with a lot of the capital that's left the sector. It's left a lot of attractive opportunities for those like yourselves, so willing to step in and put money to work. So thanks for taking the time to chat, Jack.
Yeah,
appreciate it,
appreciate it.
and look forward to following your progress.
Yeah, likewise.